Hi, welcome to the Market Alert for Monday the 5th of June 2017. So on Monday we saw the market in the British pound. Start off with the pound moving lower, trading down to the 128.50 level. The market then trading sideways, waiting for the non-farm payroll figures due out at 1:30. The market had spent most of the previous 2 days waiting for this news. And this is one of the economic news items that you don't want to be in the market when it's actually announced. There's a lot of high impact news items really shouldn't be, like factory orders and purchasing managers and all that sort of stuff. But something like non-farm payrolls is a major one, because this is the one the Fed's been using to determine whether they should increase interest rates or not. So you need to be out of the market before this one is released. And the market came back a few times towards break even and just a small profit, allowing you to get out of this one with the minimal of losses, because we know when the markets release the figures, and if I can just find those for you, they came out far worse than was expected, as you will see. There you've got 138, they were forecast at 181. Now this is really bad news under normal market conditions, ones that aren't manipulated, and where the market dictates now that bad news is good news. So the market releases the figures, and we see the reaction, a huge spike up there in the pound. And that's the reason why you don't want to be in for the non-farm payrolls or FOMC meeting minutes. And then you'll see the market come back. And then I switched over to the Dow. So we've had the release of the Fed minutes, and this is the reaction we've got. This should have absolutely fallen out of bed, but it doesn't. The market barely moves 50 points. It should have dropped hundreds of points based upon how bad this news was. And then the market gets to the open. You'll see we have a market trying to find support there, and then we get I'm just back at the pound there. I was just having another look to see what was going on. And then we get the market open there, putting in a buy signal. This wasn't filled, and then we get a sell signal. Now already this market is showing that it doesn't want to move lower. We've seen the market find support here, and then the start of the session as well. But we get a sell signal. The market fills this, and then the market trades sideways. We get a buy signal, and the market doesn't want to fill this either. We can see the market doesn't want to sell off. It's just trading sideways. And then all of a sudden the market explodes. They get the chance and they just send the market to the upside, as they've been doing for the last 10 years. So see the market trading back at all-time highs, trading sideways. That objective achieved here, as you can see from this sideways move. The market's high. It's Friday afternoon. We've done what we needed to do. We can go into the weekend knowing that we're sitting on the all-time highs. A buy signal comes in, but just for good measure, let's just put in a shakeout, as you'll see in a second. This is called a shakeout. Market sideways, got a few points on it, making no progress. It's Friday afternoon, and you'll then see the market shake out. So we shake out, get rid of the weak longs, and the market then trades sideways. A very, very strange day for Friday, but hopefully when you look at it like this, you can see precisely what's going on, and it's a lot easier to read. It's just a shame over here they didn't move the market with the buy signal there. They didn't move the market to the upside a bit quicker. Actually, it would have been ideal, because we could have ridden that way, but as we have 3 bars, and if it's not filled within the 3, then we leave the trade alone, which is a shame, because we can see what the market did thereafter. But there's nothing I can do about that. They just kept it in this sideways range, and then move the market out after. And what have we got? Let's have a look where we are in the picture of both markets. We'll start off with the Dow. This is the overnight market. You can see prices are sideways there, but still on the highs. In the daily chart, let's have a look here. We've got a new high that we can actually mark up here. This is the new all-time high. We will delete this one now. Let's have a tidy up of the chart. And there you can see we've got a new high at 21. Oops, just get rid of that. 21,228. We'll just save that as well, so we've got it there. So the market continuing to move higher, but you only have to look down here and you can see that there's no major volume moving this market to the upside at all. There is something interesting going on here though. You've got the market moving higher in this bar here, which I'll just draw in. Oops, wrong one. In this bar, and this is the corresponding volume. And then on Friday the volume's greater, but the market's range is less from the high to the low there. So that indicates there's a bit of selling pressure around, which is probably why the market's below the recent high at the moment. Until that's absorbed, they can't move it higher. And on the pound, let's just have a quick look at that market. Fairly sideways, and likely to be sideways this week as we head towards the elections this Thursday. So again, as far as the pound's concerned, unless something of a geopolitical nature comes out, the market's likely to be sideways. Let's have a quick look at the economic news today. We've got holidays in Germany and France there. They're both closed. That's going to add to the market being fairly quiet. And what else have we got? Anything released in the UK today? We've got the services PMI. That's out at 9:30. And then it's over to the US. 3 o'clock we've got factory orders and the ISM manufacturing figures as well. They're forecast to be unchanged, and then that's it. So it could be quite a quiet day, unless again, as I say, something comes out of the blue. Now something is going to come out of the blue shortly, and I'll show you why. Let's have a look at the implied volatility. So on Friday we had a new low in the implied volatility. You can see there we've got 7.85 down from 8.01 on Thursday. This is a 11-year low for the implied volatility. We've not been here for 11 years. This is ringing alarm bells that there is a major correction coming in this market. We keep getting these new lows in implied volatility, and as I discovered way back in 1994, when the implied volatility gets to multi-year or historic lows, the underlying market will make a major move. The only thing is you can't give the date and time, but we know as a warning that something is coming. And it's not just in the implied volatility either, but we're getting lots of news as we've seen last week. We'll go through some of this. Let me see if I can find the one I want. We'll start here, that'll do it. So during Friday's session there was a lot more news coming out. We've got central banks now own a third of the entire 54 trillion global bond market, and to be honest with you, they should change this to debt market. It's a debt market. They own a third of a trillion. Sorry, they own a third of the 54 trillion of the global debt. No surprise there at all. This one's an interesting one as well, because those of you that are following last year, Vancouver had a major housing bubble. The market corrected a bit when they brought in a 15% tax for foreign buyers, and that cooled it off a bit, but now it's just done the impossible and gone back to the all-time highs. Here we've got quite a bit of news as well, just to give you a picture of what's going on. And again, you tie this in with the lows in the implied volatility, you know there's a problem coming. We've got the car rental industry shakeout coming, no surprise there. What have we got? Just move through these other ones. There's only a few I'm actually after. Okay, now it must be in this one then. This is the one I want. Yeah, we've got this insanity here is the surest sign the stock market is ready to pop. And that's the number of major investors who are coming out, either giving funds back to their clients, like the Australian hedge fund whose name escapes me. I can't think what it was called. So he's not on his own. Barclays are saying things. JP Morgan are saying things. And it's purely and simply because the markets are so overvalued and in such big bubbles. Stocks hit record highs. Shrug off transitory coffee. That's obviously down to that spelling mistake or something that Trump made in a tweet in US macro data. And as I said earlier, that I can't see Yellen increasing interest rates with the drop from a forecast of 181 to 138. David Stockman there warns Trump not a snowball's chance in hell of reaching 4% growth. Obama didn't even reach 3% during his 8 years. There's a bankruptcy filing there. Gimbori, clash between... and this one, we'll finish with this one. Well, the last two here. This is RBS warns equity markets have entered the FOMO stage. Fear of missing out is what the acronym means there. And then this is also nice to see as well, that Deutsche Bank trader admits rigging precious metal markets. The precious metals are the most suppressed prices. Silver is the most undervalued asset on the planet, and the reason for that is because there's been a bit of a cartel thing going on with a few of the banks, which you'll know again if you've followed the market alert for the last year. There's been a rigging of the markets and a few fines, but now we were all called conspiracy theorists because it just didn't add up at all. There's just no way the figures add up for the price of what silver currently is. It should be exploding to the upside, a bit like all of the cryptocurrencies at the moment. And that's about it at the moment. We'll bring in something else for you tomorrow. The yield curve is flattening, and that happened in 2007 and 2008. And we'll look at that tomorrow as well, just as another piece in the jigsaw of how this thing's starting to unfold, and going forward how we're going to see things start to increase in the volatility and move to the downside as well. There's generally, you can feel it as well. It's not just all of the data, but also there's a sense that something's not right. I mean, you can see the world falling apart before your very eyes, whether it's terrorist attacks or Trump comments or whatever, and the liberal side, the whole thing is just an absolute mess. So we know we're on the cusp of something, and I'll say it again as I conclude. They are going to dump this lot on Trump. There's no doubts about that. They despise him. The deep state despise him. The establishment despise him. Other global leaders despise him. And if they could dump this lot on somebody, they're going to dump it on Trump. That's for sure. Right, that's it for today. I will see you in tomorrow's market reporting if anything needs to be said. But other than that, thanks for watching. See you in the next one.